Do you have it emailed to yourself?
Yeah, I guess, and then email that to you.
Or it's fine, and we'll just have to connect everything.
We have 4 and 4 and then 1 and 8.
Yeah. No. Too many. See? Yeah.
Because you said 4. Oh, him.
3.
Oh, okay, so it's like, okay, I said 1.
No. Together we have 1, so that makes 4 for me. Yeah. Morning. But then we're all in the house.
Yeah.
Mine are grown except the baby. She's 5. She's 6 actually. Yeah.
I mean, it's odd not getting it.
Yeah, I don't know why.
I missed mine.
I mean,
I know.
Sent it twice.
Mhm. That's weird. Well, we can just connect yours.
Okay.
I just need to, where's your internet? Do you have Chrome or what do you use for internet?
Whatever y'all are using.
Oh, there it is. Look
Hey,
at that.
Sweet.
Okay. Let me download it here. Y'all, we're just getting the PowerPoint, everything loaded, so it'll be a few minutes.
There's perks of coming to in-person classes. Fresh saltwater taffy from Florida. Yeah, have some. Yeah, I was just there last weekend. All sorts of flavors. Grab a few.
Okay, I was like, I'm all looking for my specific favorites.
It's all down there.
They
yeah,
are,
yeah.
they really are.
It's all good. It looks like we're gonna have plenty for everybody, so just pass it on. Yeah.
How was the weather?
A lot cooler than here.
Yeah.
Yeah, but I'm originally from Destin, so it's always a little humid.
Love it there. I went once.
Yeah, my parents and brothers still live there, and took my daughter, and
Do you have a rental there?
I actually do. Yeah, I bought a house like 2009-ish, and then moved 12 months later to Austin.
Is it close to the beach?
No, not everyone that's from Destin lives on the beach.
No, I know, but still, I'm just.
No, it's like
For my selfish purposes.
yeah, no, but I certainly help you, find right Airbnbs, but it's actually walking distance to the only elementary school in town, so it's really cool.
All right, we're just getting the projector on and we have about 1, 2, 3, 4, we have about 5 people online too.
Cool. Should we shut that door or just leave it
Yeah,
open?
if you want, if you want to,
No,
just so,
They're out there at work.
yeah. And y'all, this is being recorded, so it will be posted on the YouTube channel, but we just have the slideshow here and then Travis is gonna be talking.
See that, all right?
It will get a little bit brighter
Okay.
here. And I'm sharing it here too, so we'll go ahead and give
Goes on.
Travis as much time as possible, because I'm sure questions will come up.
Yeah, that's what I would say. Thanks for coming. Thanks for being out there in the internet land. If you've ever come to one of, our presentations, we definitely, recommend and want you to ask questions. So if you have something while I'm talking or you want to save it to the end, just feel free to shoot it to me. I find it's a lot more productive when we can kind of have a back and forth with this. So we've done a lending 101, and then I was talking to a couple agents of what we would think would be maybe helpful for you as a next topic. And so we did do credit 101. And so Tyler and I put this together, and my goal for this is, at the end of this, is not to make you a credit expert, but at least to give you some knowledge that could help with your clients or maybe even yourself. So again, ask any questions as we go along. But let's go. Cool. So can you move that little thing? Oh, awesome. So first thing, we get real literal here. Like, what is a credit score? So according to Webster's, credit is the ability of a customer to obtain goods or services before payment, based on the trust that payment will be made in the future. So credit has been around since like the Bronze Ages. People, trading tools for bronze or gold. Credit's been around when our farming industry got started. The government would lend seed money to our farmers. And you've probably lent money to your friends, and maybe you got paid back, maybe didn't get paid back. But credit's been around for as long as we've been around. Go ahead and hit the next button. So just recently, when I say recently, in the 80s, a credit score was established. And a credit score is a number assigned to a person that indicates the lender's capacity to repay a loan. And this is important for a couple reasons. One, it gives everyone a level playing field. It gives everyone a fair chance to obtain a loan. There's no more, oh, I know him and he's going to be good for it, or not giving loans to a certain race or demographic or whatnot. Everyone gets the same chance to have a credit score. You can also be called a FICO score. You may have heard that term before. Basically the same thing, just another tomato word for it.
What does FICO stand for again?
Oh gosh,
Federal
she's
something.
stumping me.
I know.
Yeah,
Information.
yeah.
Moving
And
on.
then so now this is a little bit suspect for me, but a credit range can range from 300 to 850. I've been doing this for a while. I've seen some stuff in the 800s. I've never seen anything in the 300s. Like, and quite honestly, that would be very impressive if you jacked your credit up to 300. Now I've seen some stuff in the 400s before, never anything in the 300, but the official scale apparently goes to 3 to 8.
So you get 300 just for existing.
Dude, you have zero. You'd rather be better just have zero than 300. Someone, yeah, no, it's actually a great question. Someone who has like literally no credit will come across with like zero on their score. And we can actually have programs that work with that. It's better to have no score than something in like the 3 or the 400s, because we can either establish some credit, which we're going to talk about, or have a program that no credit score is needed. But I've never seen anything in the 300s.
It's actually good. It's good to know.
Yeah. So what makes up a credit score? The number one slice of this pie right here is payment history. I mean, sounds pretty straightforward, but it's pay your bills on time. Whether that's your car loan, auto loans, same thing, credit cards, whatnot. I understand that not everyone is used to having credit, or maybe not know how credit works, but sometimes we'll get people who apply with us who haven't made their car payment in the last 3 months, but then they come to us to try to get a mortgage loan. Well, if you can't handle your $200 to $500 auto responsibility, we're probably not going to give you hundreds of thousands of dollars to buy a home. But this is definitely the number one factor of your credit score, is paying your bills on time. The second part of this is the amounts owed. This is a big part, and especially with like credit cards, we see that people charge their credit cards up and have their balance really close to the maximum. That's a killer for your credit score. So the rule of thumb is to have it around 10 to 30% of what you owe. So if your credit line is $10,000, trying to keep that balance at 3 or below is really like how you impact your credit score. Of course, things happen, right? Maybe the holidays come around, or maybe you have some sort of automobile emergency and you need to use your credit card. You pay that down later on and your score fluctuates pretty quickly. The next one is the length of credit history, and this is pretty important, and I actually have a couple personal examples. So how long you've had your credit open is a big factor, right? Especially in the mortgages, we don't want the first taste of you using credit to be hundreds of thousands of dollars. We like to see that, okay, he's had a responsible credit card, or she's had an auto loan payment for a while. But again, a couple personal examples. One, when I was in college back in the day, there would be credit card reps on campus, and they would offer free pizza if you signed up for a credit card. And I was young, dumb, and hungry, and so I would sign up for these credit card offers. And in my mind, I'm like, all right, I'm gonna do the smart thing and put the address to my parents' house, so this credit card doesn't come to me, and I start charging up in college, because I knew that would be a disaster. Well, I graduate college, I go get my first job at a financial institution. They pull my credit report, and they're like, hey, you have pretty good credit, but you have like 35 open credit cards? I'm like, what? And so apparently they turned on the credit cards for me, even though I never signed up for them. And this was back in the day, but I was fed all semesters with all sorts of free pizza. But the second part of that example is I actually kept one of them because I knew it was a good idea to have that credit card, just to build up history. And just recently, I never used it because it was just a really awful deal, but I kept it for a credit link. But they sent me some letters that I just disregarded, and they actually closed that credit card of mine, the one I've had for a long time. And that impacted my score a little bit. It probably dropped it 10 to 15 points because my credit history went down. Now I could build that back up pretty quickly, but just kind of a personal example of how important your credit history is. Go ahead.
If I need to close a credit card, I know like if you have to close some kind of credit line and you still have things out on credit, it's gonna lower your score. But is it as impactful as long as you have an older one open?
Yeah, so great question. If you want to close some credit cards and it's able to, close the newer ones first.
Okay.
Because definitely try to keep that long one.
Old one.
Yeah, exactly. Because mine was like, had like 13, 14 years worth of history, but I just lost.
Yeah.
And it was on me. I didn't check my mail. I just thought it was like more advertisement, but because I wasn't using it, I wasn't swiping it. Because I just didn't need it.
So like every once in a while, I'll run like a little charge.
Yeah, like I have a,
Cycle.
I have a Target card because you get 5 or 10% off for using it. But if I don't use it every 6 months, they send me a notice and say, hey, you better use this or we're going to close it on you. So I go buy a Target run, pay it off, it'll be good.
How do you know when you're closed?
I mean, you don't have to close them. It's people's personal choices. If one, you just don't want to have that card anymore. If you find a better card, you want to do a balance transfer kind of thing, but I would try to always keep your longest one standing because it's an average, right? It's your oldest card, your newest card, and anything in between gives you your length of credit history. So losing that long one I had, it impacted me a little bit.
So that effective, like say you max out your credit card and they're offering you this card for like no interest, like for a certain amount of time.
Yeah, sometimes you can do those balance. I think you can do those balance transfers and still not close out the card. You'd want to double check. It might be one in the fine print of it, but just establishing this is important. Same thing with like an auto loan. We see it all the time that when people pay off their car loan that they've had for 5 or 7 years, their score actually dips a little bit because they just lost that credit history. So, it seems unfair that you handled your business, you paid it off, and then you lose a little bit on that. The other two small slices are new credit. When you get a new car loan or you get a new mortgage loan, your score might take a little dip because you've affected this credit history and you just added something new. And this is actually a really important one we see all the time. Types of credit. I'm kind of surprised it's only at 10%, but we'll see when types of credit means like installment loans or revolving loan. An installment loan is like your car payment, right? You got 60 payments. When I pay it, I'm done. Revolving is more of a credit card where you pay that minimum payment and it just kind of goes back and forth. And so having both is an important part. And we see these with our mortgage applicants that maybe someone doesn't own a credit card. And so they're losing that type of credit to be reported to their profile. So sometimes it's a recommendation that we tell people to go get credit cards because they don't have any kind of thing. So that's the overall thing. The one part that's not in here that I'll address, and we get this all the time, is on the lending side is, oh, well, I don't want to get my credit pulled because it's going to impact my credit score, right? Your credit is made to be pulled. I mean, it's there because you're trying to get loans and services. When we pull your credit, we're getting the snapshot right then, that day. It's not like we pulled it and it affected it that moment. Now, if you go out every weekend and get the department credit card, pulled and trying to get the good deals, then you're going to see your score going down. But I always tell people that, like, if you occasionally have your credit pulled, you're never going to see that fluctuation. Like, you're all good.
So what about whenever buyers are speaking to multiple lenders and they have to run their?
Yeah, great question. So there's a window of opportunity that when you're with if you're shopping for mortgages, and it's typically like 3 to 6 weeks that we can pull your credit, and I pull it and then lender XYZ pulls it. We're typically going to get the same report. Now, if something had happened in between that time, like you missed a payment, that could have affected your score, but the actual pulling of it, that they let you shop for similar services. Like if you ever gone and got an auto loan, like from the dealer, like they actually send it out to like 10 different people, right, to find you the best deal. And so you'll see 10 different people pulled your credit, but it all fits in like one bucket.
What about, because isn't it like one point with like soft credit runs like that?
Yeah, so I don't know.
So would it be, in that example of a car dealership, would it be 10 points deducted?
No, it would all be the same pool. Yeah, and a soft pool is exactly like it sounds like. That's what happens when you go like get a cell phone or a cable bill or starting electricity, whatnot, they typically do soft pulls there. And then we actually have the ability to do soft pulls at Streamline. That's a new tool I never had in my mortgage career. And it's great because sometimes people aren't ready to shop right now. Like, hey, I'm ready to shop next spring. Well, why pull their credit now and have a ding on it when we can do a soft pull? And it's, in my opinion, is just as accurate as the hard pull. So just a cool tool to have. Cool. All right, credit ratings. So I got my man Bill and Ted here. Their key phrase was excellent. And now it's time for a trivia question. I hope someone gets this. Can anyone name the band that they were in the
Wall
movie?
Science.
My man.
I had no
I
doubt.
think you named the Fred stuff.
Oh, my man. Here's a white chocolate $10 from Destin, Florida. Yeah, I was hoping someone would get that. All right, well, so, yeah, man, that's great. So 850 to 760, excellent, right? That's really fantastic credit. You've handled your business, even very good. Like, this is probably someone that doesn't have any negative remarks on there. Could be someone who just started credit. So if you're in this range, like you're doing the right thing, and there's ways to get from 750 and up. Those are two excellent credit categories. Even the next one at 699 to 660 is considered good. 659 to 620 is considered fair. And I did it. I kind of created these brackets because in our world, 620 is the goal for us. We can do loans as low as 580. They're not attractive. I mean, and I tell your clients that, like, hey,
What does that mean though?
like, they're going to cost more, and there'll be a slide coming up, but it's going to be higher rates, it's going to cost more fees. So like when, you hear us say it or any other lender, like, hey, we do loans as low as 580. Sure, we do them, but they're not great. Like, and there's a reason. Like, you've probably not handled your business and done something to affect your credit rating. And, people need to keep in mind, like, this isn't play money. This is hundreds of thousands of dollars that we're giving you to, to buy a house. So anything 579 or below is pretty rough. And, we would need to look on addressing that. We have another slide coming up, but these are just general credit ratings of what we see. Cool. So credit reporting and how it impacts your mortgage. There are 3 credit reporting agencies, and you may have heard these terms before: TransUnion, Equifax, and Experian. Now, these are for-profit companies, these 3, which, that's a whole other conversation we can have after this class that I talk about. But, they actually have stock symbols, and you can invest in these companies. I bring it up because what we've been seeing on our side lately is that these companies are actually selling leads to other lenders. So when we pull a credit report, TransUnion, Equifax, or Experian will send your client's information to random lenders, and they'll call and say, hey, I see you're trying to get a mortgage. Can we talk to you about it? Kind of thing, which kind of sucks. Now, there's some stuff we do to try to prevent that, but I only bring this up because I try to relate this back to y'all's world. If you ever get your clients asking about that, it's obviously not us sending information to other lenders and competitors. It's these people who are in this for profit. And the way we use credit scores, we always use the middle score. When I say we, that's every mortgage lender under the sun. So in an example where we pull credit score, because there's 3 different companies, you're going to have 3 different scores. So if someone has a 750, 725, 680, their score would end up being 725 that we use for that mortgage loan application. Now, if you have 2 applicants, partner and partner, mom and daughter, whatever it may be, we use the lower of the 2. So this is important because if this first person has a 625, but the spouse has a 620, well, we're going with the 620. And so we see that a lot with people wanting to add cosigners that, oh, okay, maybe I don't have enough income, I'm going to add a cosigner. Well, it needs to be the right cosigner with the right credit score. I also see it a lot with new couples that are thinking that they want to get in a house together and, boyfriend and girlfriend, whatever. And then the other ones didn't know how bad their credit score was. So that's pretty uncomfortable conversation sometimes when I got to break that news. Yeah. So we always use the middle score, and it would be the lower of the 2 when we have 2 applicants.
I have a question.
Yeah.
So in a case like that, if there's no way for you just to, sorry, I'm trying to think.
All good.
Okay, so in a case like that, what if you just, if the partner with the lower score has money saved up in their bank account, would it just be best for them to gift it?
Potentially, yeah. I mean, if it's like a month, like if the issue is like, oh, we don't have enough money, right? Then, and we don't need that cosigner for like income purposes, then yeah, absolutely, we'll gift it. Now, that's a whole other conversation about the gift and who it's coming from. It's got to be an interested person. But typically when someone is getting added to a loan for a cosigner, at least in my experience, it's because they don't have enough income. Right, so we want to add the right cosigner. We don't want to add someone with a ton of debt and no income because that's not going to help.
Yeah.
Now, it's my understanding that with auto loans, like sometimes someone with a low or no credit score can get, someone with a higher credit score, and that makes a difference, right? And I think they go off the higher one. In our world, totally different. We're going off the lower of the two. That's just keeping it fair. Cool. All right, so this might be my
That's
favorite
funny.
slide. Credit karma versus reality. So you expect this, but this is what you really get with Credit Karma. So full disclosure, I use Credit Karma, right? And it's a way to help track your score. It is not your exact score at all. And in my experience, your score can be up or off up to 50 plus points. And then the most common thing we get is, but Credit Karma said, like, Credit Karma is just not your score. It's a good tracker and it's useful to use. And exactly why I put it, used to track, not for exact. And what I mean by that is, if Credit Karma says you have an 800, you're not going to have in reality a 600. You may have like a 760 or something, which are good scores, but it's not going to be to the number. And those numbers are important because there are certain baselines. There's a big difference at 620 credit score and 619 in my world with what I can offer you. So that 1 point can make a huge difference. And here's your second trivia question. So Credit Karma to a lender, us, is what blank is to a realtor.
I know the answer, but I'll let someone else answer.
Dang it.
And
No,
Zillow.
y'all.
I know, it's not realtor.com, it's the other, what is it? Zillow, dang it.
Liz got it online, but
No, it's.
Now, what's the name of the?
his estimate.
There you go, there you go.
No.
No,
Well, I'm gonna say
if I didn't,
ABN.
if she said it.
No, she already knew.
Oh, no, I already knew.
Yeah,
And I
yeah.
knew he was gonna talk about it.
Yeah. Well, here's another expectation versus reality. I had to fly with these. So expecting a full one, but the reality is a broken one right here. So, yeah. But the same thing in y'all's world, right? Like, oh, well, when you're going to list your people's places, they're like, well, Zillow says my house is worth $4 million. Yeah, well, Exactly. So, again, use it to track, not for exact. I use it, and it's important that if you see your Credit Karma score drop, then something may have happened, right? And that's pretty accurate. So you definitely use it to make sure that, no new trade lines were put on there. Nothing was, added that wasn't yours. Credit reports can be full of errors, which is, kind of scary. So it's important to review your stuff and make sure it's updated correctly, especially if you've been paying off bills or, we deal with occasionally people getting fraud. I just helped one of your colleagues that their person had fraud from New Orleans while we're under contract for their new build. So we had to get that all resolved. And I put this down here, this annualcreditreport.com. We've been using this for years, but it's the only what's the right word? Legitimate website that you can go and pull your credit report for free. It's the exact report. It's not going to give you your score, but it's at least going to list out all the items that are on there. And you can pull it from each bureau. So what I suggest to y'all, your clients, whatever, is pull it every 4 months and then just check it and make sure it looks legit. If you're really curious about that, you could go to YouTube, type in 60 minutes credit reporting errors. It's like a 15-minute segment of how many millions of errors are on credit reports. So it's very important that you and your clients stay on top of it because mistakes happen on the reporting and they can be costly. Cool. So I wanted to kind of show y'all what a credit report actually looks like. And these are real items that I've taken off some of your applicants. There's no identifying information on here that you would know who it was, but just to kind of show you what we're looking at. or, when you pull your own credit report that you can see it. So this first one, this is a company called Bridgecrest. It is an auto loan, right? It says here, right here. So it's an installment, right? We got so many payments. This one's 68 payments, kind of a weird month. But at $465 a month for their automobile. They owe $15,000, and at one point it started out close to $19,000. Opened it in December of 20. The DLA stands for date of last activities. That's the last time it was like a payment was made or updated. This stands for B for borrower. If I had two people, it could say C for co-borrower, or if it's a partner and partner on there together, it could say J for joint. Been reviewed for 20 months, and this is really important. What we look at is that no late payments at all. Like they've handled their business. And this little thing, a little technical, but this stands for Experian and TransUnion. Those are the two that this auto loan happens to report to. Like we mentioned, there's 3 of them. And that's why we always take the middle score, because not everything always reports to all 3 of them. So this one just happens to report to the 2 of them. The second one, Capital One, right? Like what's in your wallet, credit card kind of thing. This one was opened in 2019. You can see the high credit is 4,000. That's their balance on it. They don't owe much on it, right? They're doing pretty good, keeping it at $416. When they apply with us, like what I have to factor in for their debt ratio, which you may remember that term from Lending 101, $25, right? So in our world, sometimes it's not about what you owe, it's about what that minimum payment is. And when we're helping people pay off debt to help qualify, we really focus on the minimum payment. Because sometimes we'll see, credit card balances with a higher amount, but the payment is lower. So it just makes more sense to take care of something that's going to have more of an impact on a monthly basis. That's how we do it, monthly basis. This one's been open for a while, 43 months. What's a little different in here is this is A for authorized user, which means that they didn't open that account, but they're able to use it. I see that a lot with parents who maybe have put their children on credit cards to help them establish credit a lot, but we still have to factor that in. And you can see that these 3 are reporting to all 3 bureaus. So that's great. So it's, these are 2 great reporting things for your credit report. These are different. This is what we see on credit reports, collections accounts. So that innovative, it just happens to be the collection company. What happens is if you owe a creditor money, they may send you bills to try to get paid. And eventually they're like, look, we're just not going to deal with this anymore. We're going to send it to a collection company and just hopefully get some pennies on the dollar out of it. So this person, for whatever reason, left a $539 balance at an apartment. Yeah, so that's not really what we want to see as a mortgage loan officer, that you couldn't handle your apartment obligations, right? Now things happen, right? You can go take care of this and whatnot, but this collection account will hurt your credit for sure. Even though there's no payment associated with it, we still have to factor in something to tack against you. There's a formula, and I'm not going to get that detailed in it, but an apartment collection, definitely something that we don't want to see. This one, then the J is for the joint, only reporting to one of them. And then whoever opened this collection did it in 2020. So, it's a couple years old, kind of thing. The next one, this is after the collection company is done with it, or maybe the company itself just didn't want to fool with it. They said, forget it. We're just going to charge this off. Meaning, like, we know we're never going to get paid for this. So this goes on your credit, right? And this is an interesting one. Like, you look at enough credit reports, you can kind of see someone's story. They opened it in 2017, right? The date of the last activity was 4/17. Well, they've got a 90-day late. So to me, that says someone went and opened up this revolving credit card, charged it for $230 and said, forget it, I'm never going to make a payment on it. This is exactly what happened with this person. I mean, that crushes your credit. It was a new line, you never made a payment, and now you got 90 days late on it. So this is something that we would potentially ask someone to take care of if we needed to. If their credit score is where we needed it and it wasn't impacted enough, then we would, we would deal with it on our own, not necessarily have to make them take care of these two items, but these are just killers. This crushes
Why
you.
wouldn't you just pay them?
Well, I was
People
gonna
are serious. I don't know.
Yeah.
Fair enough, fair enough, I get
say,
it.
what if it was a identity theft?
Yeah, it certainly could be, right? Like, and again, someone from New Orleans had a credit union I worked with a while ago, and that they opened it up, and that's a really good point. Like, that could have been that. I know this person, it wasn't, but that is absolutely like one of a really great analysis that it could have been identity theft. But they owe $230, never made a payment, and then after 90 days, they said, "Forget this, we're turning it off. We're not even paying it."
It says consumer disputes, so they're saying they didn't know that.
Yeah, so that's why I put this example in here. So as a consumer, you have the right to dispute anything on your credit report, right? And the credit bureaus have 30 days to give you an answer back. And sometimes there's errors, right? And disputes happen out. Sometimes people just go put disputes on to try to hope for the best, and it gets removed. Depending on how many disputes there are, we may have to ask your client to go get these disputes removed. Like, if it was just this, we probably don't have to. But if they had thousands and thousands of stuff in dispute, then we would have to ask them to remove it, because what the dispute does, it actually kind of like freezes that item on your credit report, and it's not really reporting accurately. So that doesn't give us a clear picture of what's really going on. And our underwriters may say, "Hey, you need to get all these disputes removed," which is a pain to get done. No lie, it's just not a great process. This third one is not a bad trade line, but we see it all the time. It's a student loan. Yep. So this person had 32,000 and change in student loans, opened in 2020. You can see that the high credit 32,000 is exactly the same as the balance. It's because they're not making payments on it, which is okay. Maybe it's deferred. They could be teachers. COVID, we had some stuff for a while where people weren't opening it. What we have to do, though, you see the zero, that means there's like zero payment associated with it. Depending on the loan program, we either have to take 0.5% or 1 full percent times this balance and add it into your like debt profile. And we get this all the time that, "Oh, well, I don't have to make payments on my student loan. I'm a teacher that's going to get forgiven," or something, which very well may be the case. But what if you're not a teacher next year? You're going to have to pay on the student loan. So we can't just, go forward with not adding some payment. But luckily, most of the time, it's only 0.5%, which is, hopefully wouldn't change us in, an approval range. But this is, two bad examples of, what we see on credit reports, and then very common student loans. We see those all the time.
So you said it's 0.5% to.
Depending on the loan
2%?
program, like FHA, we have to use 0.5%. Conventional, we have to typically use 1%. To get real technical, there's a couple different options on conventional, and one of them chooses 0.5% over 1%. So when we're trying to figure out what, where your client fits the best, this may come into question. A loan I'm closing on Friday had over $100,000 in student debt, and we had to use the 0.5% option to make the debt qualify.
Sorry, I went too fast.
No, I think we're good there.
Okay.
Yep. So, how does your credit score really impact you, right? We just talked about what credit was, how we get those numbers, what's all made. Like, here's some real life example. 500K home, 5% down. 800 credit score, and these rates are just something I created weeks ago. I'm not saying these are today's rates, but just for an example purpose. Your principal and interest on that first one, 2,478. Well, drop 100 points, your rate's going to go up about 0.25%. Yep, so it makes kind of a difference. Here's the crusher, 640. Rate's not too much, but you may have heard these terms before. You're going to end up paying points. So $8,500 just to get, the same loan at 5% down. Now, the reality is we may put this person in an FHA loan, which is a whole other thing, but maybe the property doesn't accept FHA financing. So if your client had to do a conventional loan and you're comparing, then this is what the big thing is. Something that people don't think about when it comes to credit scores is the private mortgage insurance, the PMI. Oh, do you have a question?
Maybe I should let you finish.
Okay, yeah. So obviously your interest rate on what you're paying on a monthly basis is affected by your credit score, but so is your mortgage insurance, right? So in this example, the first person's got $71 in mortgage insurance for a 500K loan. I mean, that's pretty awesome. That's pretty cheap. Well, that same person now adds about 100 extra dollars at a 700 credit score. And then that next person, it goes to 383. So your difference in the payments from the 2,549 to a $385 difference, a $1,104 difference because of someone's credit score.
So they still had to buy that 640, they had to buy down the points just to get. the
Yeah, I couldn't
270?
Exactly. Yeah, they just to even me to offer them a rate, they had to pay $8,500. Because and again, we may look to put this person in conventional, right? But just wanted to show you, like, to try to even get the similar rate as someone, you know, or we could have jacked up the rate on them.
You mean
You know.
FHA? Get them in FHA instead?
Yeah, we may have gone to FHA on this loan, but maybe, again, the property was an FHA. Maybe they're shopping and above FHA purchase price limits, whatever it may be.
So when the loans were at like 3%, what would that number have been, like 1,700 a month? Or
I mean, I would say the spread is pretty accurate, right? Whether rates plummeted tomorrow or skyrocketed on Wednesday, like that spread is not that big a difference. You know, quarter point, you know, here's a little bit more. It's the points that gets killer. So for this if we weren't gonna charge someone points on this, they'd probably be at like
I mean,
6.62.
the monthly mortgage, how lower would it be, like a couple $100 for the 800? if they were 3%?
Oh, yeah, if rates were, if that same rate was like 3.75, you're probably looking at like $2,100.
So it does make.
Absolutely. Yeah. I mean, even a quarter point, you know, changes it, you know, what is that? A couple $100.
So basically, you want me to have good credit.
Oh, yeah. Yeah. I mean, you know, I'm not the one that has to make that monthly payment, man. You do.
Hey,
So, yeah.
that $200.
Yeah. So that really, like, obviously we know that the interest rates are affected by your credit. What is, you know, still like eye-opening for me is this PMI difference. Like, you know, this person's got a $1,100 more payment. So, you know, and I'm gonna talk about what we would try to do with someone like this here in just a second, but here's a real life example of what's up.
And that PMI stays on the loan for the entirety?
Yeah, so for a conventional loan, it's based off your credit score and how much down, right? So if this same scenario, if someone was putting 10% down, they would have a lower PMI across the board on all, you know, for everybody. 15%, you know, even cheaper, 20%, you don't have PMI. On a conventional loan, as you pay down and you get to that 20% level, it will fall off.
Or you have to request it on?
You can request it off sooner. The way you do that is, you know, typically after 2 years, you can have what's like considered like a modified appraisal. So say if your property value's gone up and you've been paying down on your loan, you can get a new value and have your PMI drop without having to refinance.
And you cannot do that on FHA.
FHA is on for the life of the loan. Yep, it's never going away until you refinance it off.
So that's why conventional can be a little more.
Conventional. Yeah, conventional, well, one thing about PMI and FHA loan, it's one flat rate. Doesn't matter if you're 580 or 800. The rate is the rate, but it's not gonna fall off. And they charge you an upfront fee on FHA. It's like 1.75% of your loan amount. It's typically rolled into your loan, so it's not hard money you're, you know, shelling out at closing. But, you know, if we're comparing conventional to FHA, you know, with an 800 credit score, we're definitely going conventional all day, every day, because it's just a better financial product for that person. But an FHA, probably a better financial product for this person.
Yeah.
Yep.
So basically, I need to stay in my lane and let you do your job.
And, well, you know, I'm
That's the
not,
whole thing.
yeah, I'm not influenced by your client's rates, right? Like, I don't get more diaper money by getting someone a higher rate. I just want to, you know, provide someone the best options possible, and we give them advice to hopefully get them a little bit credit score, which I think I have a slide coming on in a second here. All right, so what happens if my client applies and has bad credit? We shame them out the door. We gotta go. We don't talk to them anymore. Yeah, we Cersei them down the street. No, I'm just joking. Here's what we do. So the number one thing is good people can have bad credit, right? Things happen in all of our lives. Could be a medical emergency, could be someone lost their job, a spouse, got injured and couldn't go to work, whatever. So if someone comes to us with bad credit, we don't write them off at all, because these are real people. We want to take care of them. We can look at doing something called an in-house repair. And this is where me or Tyler are going to analyze their report and try to give them advice and ways to increase their score. Some of those options are, easy things, paying off debt, right? If their credit card's maxed out, we may say, hey, try to get it to this certain level. I talked about, hey, we see you don't have a credit card, right? Maybe you need to go open one, and we're not telling you to go get a bunch of debt. We're telling you to get a credit card so something positive can report on a monthly basis to, help your score up. Another way we can do that is if you, like I mentioned, maybe mom or dad has a credit card, we can get you added to their credit card. And then it's like you inherited their history. Like, so say they had a credit card for 15, 20 years. I've actually seen people have credit in their name that was open before they were born. It's like, how does that happen? Well, I got added to mom and dad's credit card that they've had for 25 years, but you inherit all that person's positive credit. So it's perfect. Fighting for a collection. Oh, you're all good. So if we see collection accounts on there, it's not like we're going to have to go get you to pay those off to qualify, but we may need to. And what I tell your clients is there's two different ways you can pay off stuff on your credit report. You can go and pay it and it shows $0, but it's going to stay on your credit report for 7 years. It'll say $0, but you don't owe them anything, but like the damage is still on there as what happened. The other option, and we see this all the time for medical collections, we advise people, is called paid for deletion. That means like, hey, Mr. Medical Company, I owe you $200. I'll pay you $200 or I'll pay you $150, whatever they agree, but I want you to delete this off my credit report like it never happened. And so they will, or they'll send us a letter that says, we're going to delete it. We can update it on our end, and then it disappears like it never happened. And that's the big impact. So it's we really are cautious when we tell people about going to pay off stuff, because there's a correct way to do it. And we normally ask them to call first and to see what they say and come back to us. But if you can get it deleted off your credit report like it never happened, that's a game changer. And then I mentioned check for errors. I can't stress this enough, how stuff sometimes just doesn't report correctly. Maybe you did pay off something years ago and you thought it was taken care of. Remember, there's 3 different credit reporting agencies. Maybe 2 of them updated it. Maybe 1 of them didn't. So, and a lot of time it's human data entry. So people make mistakes. So check for errors. So if someone comes to us and just has really tough credit, right? Like, we want to help. Like, we're here to help your clients, but we're not credit repair. We can give people advice to try to get them to where they need to be. Or even like go back to that 640 situation. I may tell that person to go pay off a little debt or go pay off a medical collection. Let's get you up to 700. That's going to make a big difference for you. But if someone comes to me and it's, probably below 580s, low 500s, they've just neglected their responsibility. We have to, I refer them out to credit repair. And, you may have had clients do credit repair, people that are listening to this may have done credit repair. What I can say about credit repair, it's just like any other company in the world. There's good ones and there's bad ones, right? Like, it is what it is. I use one that if you ever need a recommendation, I can give it to you. I've used them for years. I really trust them. I like how they do their things. I've had a lot of success, but they're basically lawyers who go and fight your credit report. They dispute stuff. They go and negotiate. They do all this stuff behind the scenes to clean up your credit report. And for someone who's got a lower score like that, like, that's the plan that we've got to put them on. That's not free. It's a paid service. They're in it to make money. Typically it's a monthly basis, like, I think maybe 80 to 100 bucks. And it could take anywhere from 3 to 12 plus months. But then we can make them a homeowner. And what I'll tell you about this is, we get a lot of people with bad credit, but you can really tell who's serious about trying to make a difference if they take your advice and go sign up for credit repair. And honestly, some of the most rewarding success stories I've ever had are the ones that we can do these things and they go and they put the work in, they do it, they come back later on and we make them a homeowner. Like, that's just so fulfilling for us. Now, if they're not gonna do anything about their credit report, then that just tells me that they're not really that serious of buying a home. And there's only so much we can do to like help people, right? So we just want you to, the reason I put this in there is we don't, shoo away your people with lower credits. We try to give them some advice. We can't do it all. We'll try to do as much we can, but credit repair may be the option for your people.
And you may be talking about this later, but I think this brings up a good point. And a question you get all the time is how long is it going to take someone to affect their credit?
Yeah, so that's a great question. So not all credit scores are created equal, meaning that someone with a 580 may have a couple items, and someone with a 618 may have a ton of items on there. It's just there's a lot of factors that go into it. So when it comes to this, I kind of let the credit for people repair people quote it. I will tell you that like credit scores can be influenced pretty quickly, like whether it's paying off debt or getting added to a cosigner or existing account. Like your credit score can fluctuate up pretty quickly, and it can certainly drop pretty quickly, right? If you didn't make your auto payment 1 month, you'll see a plummet for sure. So I put 3 to 12 months because that's what I generally see on the professional credit repair side. The people I use will sometimes look at it and be like, hey, these people don't even need credit repair. If they just do X, Y, and Z, they get some free advice and move on. But a lot of times they're fighting, they're disputing, they're trying to get the credit agencies to slip up so they can have items removed from you. But not all credit scores are created the same because they all come with different things. Again, someone who just opened up credit, maybe has like a 650. They don't have no negative items. There's no bad history. It's just new, right? So they just got a time to kind of, update it. But someone who's had credit for a long time, if they missed a car payment or two, then they've gone down to 650. So those are two same scores, but different scenarios of how we got there. And that's it. So that's it for me. Like, I just wanted to kind of give y'all, some tips that, maybe not that you may be talking to your clients about credit, because I would advise to, toe that line, softly. But what we look at and what we do for your clients, again, good people can have bad credit, but we want to just, provide them advice to try to get them to where they need to be, and kind of show you what we're working with when your clients apply with. So how we're trying to get them approved.
I have a question.
Yeah.
For someone that is wanting to, I guess, dispute something.
Yep.
Do y'all typically tell them like, oh, you can call this person, and then get back to us? Or
Yeah, so if you
how
dispute
does
it,
that really
yeah,
work?
if you dispute it, it's like, I guess it's two different ways. Like you could call, I don't know, Verizon up and say, hey, like this doesn't seem right. Like, what's going on? I pay my bills, but you said I was late last payment. Like, oh, I'm sorry, we see that's an error and, we'll fix it, right? Like you're just having a conversation with them. The other way is you go directly to the credit bureaus and saying, I would like to file a legal dispute with these people. So then the credit bureaus send stuff to Verizon and they have 30 days to provide evidence that shows, no, this is correct. Your people did not, pay the loan. And, that's when that one slide said consumer disputes or whatever.
Mhm.
So that's the real dispute. Now, sometimes what credit repair does is they flood these creditors with like this one, right? Or this one. Like, so say that we disputed this, like legit dispute through the credit bureau, TransUnion, whatever, because that's the one it's with. If this person just never answered in that 30 days, just never got the mail, just forgot about it, just didn't want to deal with it, this would legally be removed and they would no longer owe that. But more than likely, the credit people are going to say, no, here's the lease, here's where they didn't show it. We're keeping this on because we're trying to collect this $539. So that's what credit repair does, is try to hit them with different types of letters and things to dispute and get things removed off.
And then, sorry.
No,
What
this is
about
good.
for like medical bills? Same thing?
Oh, great question. So medical is looked at a little bit differently in our world. We don't have to take a medical balance into consideration, right? Medical could happen to any of us when we leave to go get free birds today, right? You get in an accident. So that's what I'm getting for lunch. So the balance itself, we don't care about. Even if it's in dispute for medical, this is getting more loan officer-ish. But even if the medical is disputed, not a big deal for us. This is not medical. This could be a big deal for us. Now, unfortunately, which I've heard this for years, but I've never seen any update on it, is that if you get medical collections, it's impacted your credit score. That's nothing we can deal with. Like, we've got to go back to the fair credit reporting because everyone's got a score, trying to make it a level playing field. So, you know, medical is a little bit different. A lot of times in my experience working with clients, medical can be negotiated a lot of time. Like, they'll take, you know, pennies on the dollar kind of thing. They're also more open to removing it, like delete it off your credit report like it never happened. In my experience, if you owe the cable company, cell phone company, you know, whatever it may be, those people tend not to delete it off. I mean, they'll zero balance you, but they'll still leave the history on there, which can still be better than having a collection, but it's also, you know, on your credit report that you had a collection on there. So medical, unfortunately, you know, I wish that was looked at differently on credit reporting, but we got to play by the rules. Yeah, great question. Any questions on the inner world?
No, if anyone does, you guys can unmute. If you have any questions?
So with paying off, how you mentioned like making it disappear, but staying on your credit. So someone that I spoke with, a lender let her know, oh, you have $500 balance for your student loans. But she was like, she was saying, I paid it off already.
Yeah.
It's been paid off for years. But whenever I guess she went into some kind of student loan website, it's showing as zero, but the lender provided her a copy showing on her.
That's one of those things that just wasn't reported correctly. Like,
Oh,
they
okay.
probably need to go and talk to it. You know, in a student loan thing like that, if someone, oh, what'd you say, $500?
Yeah.
Yeah, I'd have to hit them with like a $5 payment, you know, so is that really probably not going to move us one way or another? Now, if there's negative history, you know, we'd want them to take a look at it, but that's exactly like I said, like the 60 Minutes clip on YouTube, look it up. It's kind of scary how many errors are on credit reports. That's why it's important to like check after your stuff. But that's exact reason of maybe they paid it off and someone just didn't talk to each other. Like, so what we see sometimes is that, you know, whether it's student loans, Verizon, AT&T, whoever, in their records, cool, you paid us. We're cool. We're cool, but we didn't tell the credit bureau yet. We forgot to.
Okay.
Yeah. And so then it's just a matter of, you know, dealing with them, getting a letter, getting sent up to the credit bureau, getting it adjusted, all that good stuff. Yeah. And I guess I didn't put a slide on here, but I just thought about it. You know, we can pull your people, obviously we pull your people's credit, but we also have a tool that's called like a rapid rescore. So if like someone needs to have their score updated like really quickly, like we're in a time crunch or you know, something happens, we can do some stuff behind the scenes to get stuff updated in like 2 to 3 days. Generally, it's updated every 30 days because that's when stuff is reported, but nothing reports at the same time. So your auto loan might report on the 2nd day of the month, your credit card maybe the 15th day of the month, something else the 20th day of the month. So, and you know, we don't really know when that happens for each person or each trade line, but if we ever need to do something quick, like we got those kind of tools. And on that thing as well, we also have analyzers that say, if this person paid down X, Y, and Z, your estimated score would go up by like so many points.
Oh, that's cool.
Yep.
I have a
So you
question.
can specify like. what-
Yeah, absolutely. Like, hey, address this credit card for this balance. And I'm working with someone right now who their score is 638. And if we get to 640, it's going to save them $2,500 in fees. And so I said, hey, you got a Randolph Brooks credit card, pay $2,200. You know, number one, you're paying off a credit card, which is cool, but then you're going to save $2,500 in fees on this loan. It's a no-brainer. So, yeah.
For people who are current homeowners
Yep.
and have had, I don't know, I'm trying to think of a scenario. Maybe they had a late payment or things like that. How do those things impact another?
Yeah, so being late on a mortgage is going to affect you. Now, if you had one within a year, your score is probably impacted, but it doesn't necessarily disqualify you from getting another mortgage. If you have multiple late payments within a year, automatic disqualification. Like, there's nothing we can do about the score. The score probably is low, but we do not want to see lates on.
Maybe like about a year before they can try to apply.
Generally, after a year,
After the last.
we can talk about it again. Now, this is getting more into like underwriting, but like when we take your credit report, it's full of information. So just because we maybe have like an eligible score, if it's full of bad information, like it's a risk analysis. And if we see someone was, late on their credit or their mortgage for many years, like that could still come into a factor. Like, well, I got the right score and my debt to income is, all right, but maybe we're not going to approve you for as much because we see that you had so many late payments on your credit score. So, and that's not like a personal decision. That's like ran through an algorithm kind of thing. Cool.
Thank you.
Awesome, thanks,
Yeah,
Travis.
no, I'm
Travis.
good. Yeah, and while y'all are here, if we're gonna start teaching these more often. If there's something else that you think we should add on here, let me know. Like, we want to tailor this to you. If you think of another class that you want to know about, like, I think we're gonna try to do something about what happens after you refer someone to us, like what happens to your clients. So please, we're always up for suggestions. Just because I'm teaching this doesn't mean Tyler can't help out too. You can send him all the bad credit. We can send me all the good credit. So, I'm just joking. But no, he's just as knowledgeable in this as I am.
Moral of the
So-
story is if you're talking with someone and they mention their credit or you think there's concerns, then get them in touch so they can
Well,
start
and
those
I'll leave it at this.
conversations.
You actually made me think of something else. Like, people will call and like, oh man, my credit is pretty bad. Well, definitions of bad like vary a lot, right? So like bad could be 500 or bad could be, in their opinion, like, 680. 680 is not a bad score. Like, we've got lending options for you. So, if someone you're talking to has, tells you they've got bad credit, well, get them in touch with us and let's get them on a plan, right? Let's make them homeowners later on in the future. So good people can have bad credit. Cool.
Thanks, y'all.
Yeah.
Thank you.
Some of y'all think this is taffy.
Okay.
Okay, you didn't get it.